for the month of June 2023. We will be discussing our views on the key drivers of the bond market going ahead and what kind of strategies make sense in this market environment. And then we can follow it up with some questions and answers. So we'll start with some global flavor. So on the left-hand side of the slide, as you can see, it's JP Morgan Global Manufacturing PMI, which has been in moderation for a while now. As we can see, since December 21, there's a clear downtrend, which is continuing even as last as April 23. One of the main reasons is the reopening of the global economy, which has led a rotation of spending from services to manufacturing. Moreover, manufacturing goods typically are more interest rate sensitive and more cyclical than services, which tend to be discretionary, and hence we are also seeing this downtrend. Last but not the least, there was also a built-up of inventory during some supply shortages. And since now supply shortages are now normalizing, that inventory is also leading new orders to decline across the manufacturing centers across the world. So we expect this trend to continue for a while till financial conditions ease and those inventory cycles normalize. On the right-hand side of the slide, you will see the Conference Board leading indicator and US real GDP in percentage YOY. As we can see, the leading indicators are pointing towards, again, a slowdown. And the drop in the leading indicator is similar to what we saw during 2008 and during 2001. And these leading indicators include your jobless claims, your credit conditions, building permits, wage growth, etc. So this is quite comprehensive. So a combination of all these factors are pointing towards at least a marginal slowdown going ahead. If you look at the commodity index, that's also reflective of the easing of supply chains as well as moderation of growth expectations. From its all-time high of 136.4, the Bloomberg Commodity Index, as expressed in dollars, is now gone to 98 as of 31st May 23, or a decline of about 28%. The same supply chain normalization is also playing in the food index, where the food index from its all-time high growth of 31.8% during May 21 has now reporting a 21% YOY decline as of May 23. So the effect of this growth slowdown as well as normalization of commodity prices is now starting to show in the CPI readings across the advanced economies. As we can see, the peak headline inflation, whether it's US, UK, Japan, or like Eurozone, is coming down, and we expect it to continue to moderate, both on the back of slowing economy as well as slowdown in commodity prices because of normalization of these supply chains. However, while the supply chains are normalizing, inflation is moderating, growth is also moderating, the labor market in the US is still quite resilient. Whether we look at unemployment rate, the wage growth, that still pertains to a moderating economy rather than a slowing economy. And as we can see, there has been a change in central banking outlook. So these charts are basically consensus market expectations of the implied policy rates as expressed through the interest rate swap curve. And if we see the comparison as on 3rd of May 2023 and as on 9th of June 2023, there has been a sea change. If you see till as on 3rd May, the swap market was expecting 3 to 4 rate cuts by 2024. And if you look at as on 9th of June 2023, the bond market is just pricing in probably one rate cut by Jan 24. So there has been quite a difference compared to in just last 1 month. Two reasons. One reason being the growth is still holding up despite uh, some regional banking issues that the US economy faced, as well as one of the major investment banks in the Eurozone being folded up. Despite that, credit conditions on the ground are still not as tight as some of the market participants feared in the early part of the May, and uh, and as well as the labor market still continues to be quite robust. That's also reflected in the bond prices. So if you see this, this is the table of 10-year sovereign bond yield movement. If we see the comparison between May 23 to April 23, there was a rise in US 10-year bond yields of 22 basis points, in UK bond yields of 46 basis points, and even Australian bond yields of 27 basis points. Broadly, this phenomena is more centered in the developed economies or the advanced economies, as market participants were revising their peak terminal rate expectations, whereas yields in emerging markets remained range bound. The reason being, emerging markets started their rate hike cycle quite early compared to advanced economies, so they are already close to their peak rate expectations. Secondly, because they started their rate hike cycle a bit early, their inflation expectations and on the ground inflation both have started to moderate towards their long-term targets. And hence, we are seeing consolidation happening in the emerging markets, whereas the advanced economy, the on-the-ground inflation, as well as the expected inflation is still away from their target levels. Coming to the domestic market. So if we look at, this is RBI's projection of real GDP growth for FY24. There was an expectation some time back that probably Indian growth will also slow down as global headwinds start to, kind of appear more visibly. But as we can see, for now, Indian growth outlook looks quite robust, barring deflationary shock due to some event. We expect stable to moderate growth for FY24. The reason being the Rabi production has been quite encouraging. There is a steady growth in services, and government's continued thrust on capex is also leading to strong multiplier for growth. Yes, the tide, like I said, some deflationary shock or some financial accident or a major macro slowdown, or in fact even a weather-related disruption could pose downside risk to growth. We will take it ahead separately. On inflation, as we can see, inflation has started to fall materially, both core as well as headline. And if we look at from its all-time high of 7.8%, the April CPI came at 4.7% due to the base effect and normalization of the supply pressures. And if we look at even going ahead, inflation is expected to remain well anchored in FY24, around 5% and around RBI's own projection. While inflation momentum could even further moderate, RBI has kept a slightly conservative estimate of inflation in H2 FY24 to account for any adverse impact of weak monsoon or any adverse movement in global commodity prices. Nevertheless, the headline inflation trajectory is likely to be dominated by food price dynamics and core inflation. Core inflation is largely expected to remain stable around 5%, whereas the disinflation in food or the adverse impact on food due to weak monsoon or some global shock could actually change inflation trajectory, and that's something the bond market will be keenly watching for. So one of the reasons, one of the often repeated reasons that RBI gave on the pause, or whether what bond market is continuously looking at, is the possibility of El Nino, a weaker monsoon, and its impact on food prices. So this table signifies, various previous episodes of El Nino. What was the rainfall departure from its long-term period average, which you will find in the third column. What was the food inflation during that time? What was the impact on growth? And what was the food prices, etc., globally? So one of the key takeaways from this table, which I will explain in detail, was that it's not just the monsoon which affects food prices and hence inflation. It is also the prevailing oil prices. It's also the prevailing global food prices, the increase in rural wages, as well as the discipline on minimum support prices or MSP, which determines food inflation. So if you look at, for example, 2003, where the rainfall departure was about 20% below its long period average, the food inflation was just 2.7%. One of the reasons that, as you can see, is the food price index, which is the global food prices, was actually down 1.5%, and even the MSP was up just 0.2%. And if you look at rural wages as well, they were up just 3.4%. So, one, given the low global food prices, very disciplined MSPs, and a very moderate rural wage growth as well, that did not lead to any major impact on food price inflation despite a 20% lower rainfall. Compared to 2010, when we see a 21% departure from long period average rainfall, the food price inflation was 15%. What was the reason? The reason was very high rural wage growth of 16% and a 34% MSP hike in the year before, as well as a 12% hike in MSP prices even during 2010. So these were the confluence of factors apart from lower monsoon, which led to an adverse food inflation during 2010. And if we look at recent period, which was the last where we saw rainfall being lower, that was in 2016, where the long rainfall was about 13% lower than its long period average. And even then we see the food inflation was quite moderate at 5.1%, because your MSP price hike was just 3.6%, and your global food prices were actually down 10%. So you have to see these things in conjunction. A combination of all these factors, which is your global food prices, your MSP price hikes, and your rural wage growth, all these also determine the nature of food inflation rather than just the departure from normal rainfall. And if we look at the current, global food prices, as we saw in one of the charts before, they are quite well behaved. If you look at the MSP price hikes, so far the MSP price hike is just 7%, which is also quite disciplined, and rural wage growth is also quite moderate. So we should not conclude anything right now. It's too early to determine whether the food inflation will be quite high. If in case monsoon is significantly lower, we'll have to wait and watch out for the distribution of monsoon. We'll have to watch out for how the wages pan out, and we'll also have to continuously assess how globally food prices are behaving before taking any deterministic conclusion. If we look at the interbank liquidity, at the beginning of the fiscal year 2024, it was widely expected that liquidity by the second half will turn negative, and probably RBI will have to intervene either through bond buyback or through a CRR cut to inject durable liquidity in the system. But there were two major events which has changed that view, and in fact has led to a 2 lakh crores surplus liquidity infusion. The first reason was higher than expected dividend from RBI. As we know, RBI undertook some FX intervention operations last year, which led to reasonable profit booking as RBI accounts its FX at its cost price, and it led to dividend of about 87,000 crores compared to the budgeted number of 30,000 crores, which again infuses liquidity into the banking system. And the cleanup exercise undertaken by the government of India through withdrawal of rupees 2000 rupees note, which also has led to about 1.55 lakh crores infusion of liquidity into the banking system as of 8th of June. Although this liquidity is expected to be transitory, as we have seen in previous cleanup exercise, nevertheless, this changes RBI's reaction and probably the time of intervention from early second half of this fiscal year to the end of towards the end of this fiscal year. That has implications for the money market as well as for the bond market curve. For the money market curve, this reduces pressure on the banking channels on for in terms of issuance of its deposits, as well as any substantial increase in deposit rates, and hence it is positive for money market rates. Whereas for the bond market, it's slightly negative at the margin, because the possible RBI intervention, which could have come in the form of bond buyback to inject durable liquidity, that will probably get shifted towards the end of the financial year. RBI has also clarified in the policy that right now they are not targeting a quantum of liquidity, but they want to ensure that the liquidity is priced around the operative rate, which currently is at 6.5. Hence, despite the increase in this liquidity, we are really not seeing any meaningful decline in money market rates. The takeaway from RBI's assessment is broadly that the overnight rate is expected to be around 6.5 for some period of time. This is the Indian sovereign yield curve. As we can see, the amber line represents the 31st May 2022 yield curve, whereas the light blue represents the sovereign bond yields as on 30th April 23, and the dark blue represents as on 31st May 23. As we can see, yields rallied across the curve, whether we look at the 1-year rates, the 5-year rates, or the 10-year rates. We saw yields rallying across GSEC, AAA, as well as AA, across. One of the reasons that we saw this rally, like I alluded to in the previous section, was there was a large expectation that because of this liquidity, before that RBI dividend as well as the 2000 rupees cleanup exercise, that probably RBI will have to inject liquidity through bond buybacks, and that's why we saw this rally in anticipation of those bond buybacks, probably during the month of August, September, which has now gotten pushed ahead. The second reason was also that the April to June quarter was a period of a very low net GSEC supply. That is the issuance versus the maturity. If we see and we stack up the comparison between various quarters of this first fiscal year, it was on the lower side in the first quarter, and apart from that, there was a very strong buying from long-only investors such as insurance and pension funds, which is typically high in the first quarter of the financial year, and that's what led to a rally across government bonds as well as corporate bonds. So which we expect now to kind of moderate, because one, the net supply going ahead will increase, and also because of these liquidity infusions in the form of dividend as well as the 2000 rupees cleanup exercise, those interventions which were expected from RBI, they kind of get pushed back towards the end of the fiscal year. An update on the RBI monetary policy, which happened on 8th of June. So on 8th of June, the RBI MPC voted unanimously to keep the policy rate unchanged at 6.5, while maintaining the stance of withdrawal of accommodation. Just to again reiterate, the stance of withdrawal of accommodation is largely to do with liquidity, rather than just look at from an interest rate perspective. While they say that all pauses are equal, but some pauses are more equal than others. So if you look at the market reaction in the April policy, which was also a pause, the market actually rallied despite RBI saying that war against inflation is not over. One of the reasons behind that was there was still apprehension in market participants that probably RBI may still do a rate hike in the April policy as well, and because of the pause, that led to a rally post the April policy. Whereas during this policy, the market participants had an apprehension that RBI may even change the stance. So hence, when the stance change was not really, fructify, and the current stance was maintained, that led to some volatility in the bond yields. We believe, and like we discussed previously during when we were discussing inflation, given the possibility of weak monsoon this year, RBI has appropriately retained its policy optionalities and refrained from giving any specific forward guidance. As we see globally, economic activity is still holding up quite well. There is a possibility of a food price flare up due to a weak monsoon, although it's too early to take a call right now, but there would have been no upside for RBI to prematurely change the stance without having full information at hand. And that's why we believe they kept their stance of withdrawal of accommodation. We still believe that we have likely reached terminal rates in this policy cycle, given that inflation is expected to average around 5% in FY24. There is no major reason for RBI to hike interest rates from these levels to bring down inflation. If you look at whether RBI governor or RBI deputy governor's statements across policies, whether we look at June or April or even before that, they have recognized that the journey towards 4% inflation will be a gradual journey. So they recognize that, and that's why they want to keep a certain real rate buffer to ensure that the inflationary expectations remain well anchored. And by creating a reasonable real rate buffer, they are nudging the inflation towards their target of 4%. So they are not in a hurry to achieve 4% inflation at the cost of growth. They expect it to moderate as inflation expectations get anchored. So what does it mean for bond market participants, and what does it mean for investors? What it really means is, like I said, that given that inflation has been on the higher side in the last 2 years because of various supply side shocks, RBI is probably waiting for a durable and sustainable fall in inflation and a fall in inflation expectations before changing its policy stance and probably rate cuts down the line. And hence, RBI is expected to pause for longer until they see either headwind towards growth, or they see that inflation has sustainably more or less aligned to their 4% target. Nonetheless, if we compare India's inflation as well as growth trajectory this year compared to last year, we are moving from a very high growth and a high inflation to a moderate growth and a lower inflation trajectory this year. And hence, we expect that interest rates are likely reached their peak levels, and we don't really expect RBI to hike from here on. We were expecting, to be honest, yield curve to steepen, that is the long end to slightly underperform the 1 to 4 year of the yield curve. The reason of outperformance of the long end of the yield curve in this quarter was largely, like I explained previously, one, heavy demand from long-only investors in a period of lower net supply, as well as expectations of bond buyback from RBI. Both those situations are now evening out. The supply calendar starts to get heavy from here on, both on the center and state side, as well as that liquidity injection argument or that expectation also gets pushed back, and hence we expect the 1 to 3 year part of the yield curve to perform better compared to the longer end. And hence, we are recommending investors who have allocation for more than 12 months to consider the short-term or the corporate bond funds, whereas investors who have a 6 to 12 months investment horizon can consider allocation to low duration or money market strategies. While there may be a legitimate question that given that we are not expecting any meaningful rate cuts in the near term, why invest in duration at all? So the reason we are still recommending for investors who have a slightly longer term horizon to invest in duration, that given the exceptional rise in interest rates in the last 12 to 18 months, it's really difficult, one, to rule out a deflationary or a growth shock, which could lead to significant bond rally. Or even if you look at the bond market construct today, most of the policy normalization or most of the bond market normalization has largely happened. So from a repo or effective policy rate of 335, we have already reached a 6.5. If you look at globally, the Federal Reserve from 0% interest rate has reached to 5 quarter, and the most aggressive rate hike cycle we have seen in the last 30, 40 years. Given the very rapid pace of these rate hikes, it is possible that we may see some financial or growth shock, which could lead to a rally. And at least one thing we can expect at these levels, that we are possibly close to the rate hike cycle. And if you look at the real interest rate, which is your expected inflation compared to your market interest rates, they are still quite compelling. For example, if you look at even a 3-year AAA PSU bond, which is trading between 740 to 7.5, and if you compare it to expected inflation of close to around 5%, the real interest rate, even on short-term bond segment, looks quite attractive. And even if you look at, consider it from even a 6 to 12 month horizon, from a money market curve, a 1-year bank CD trading around 7.4 to 730, compared to the expected inflation again of 5%, looks quite attractive from a real interest rate perspective. So that was largely from our side. Happy to take up any questions. Thank you.
Yeah, sure, Anurag. Thanks a lot for a detailed overview on the economy and on the fixed income markets. So we will now move on to take questions from our viewers. And I request the viewers to continue to post their questions in the chat box, which we can take up in the next 20 or 30 minutes in the given time. And so before we start with Q&A, so let me also mention here that Anurag is our frequent contributor to our blogs on the markets, market events, and the RBI policy, etc. So which are hosted on our website under Knowledge Corner. So we urge our viewers to visit our website and make use of the blogs. And we also urge our viewers to share your feedback and suggestions, and you can write back to us at askuti@uti.co.in. I'll repeat, askuti@uti.co.in to share your feedback and suggestions. So Anurag, here is the first question to you for the evening. You echoed in your deliberation that rate hikes are reasonably off the table for moment, with both FOMC and MPC calling it a pause, right? So Fed and RBI both clearly saying they are taking the stance of pause. But however, are there any catalyst looming which could reverse the actions?
Thanks for the question, Niranjan. So I wouldn't say rate hikes are off the table, but like you rightly said, that both the central banks are right now in a pause mode as they really assess the impact of previous rate hikes. And like I said, given the rapid pace of rate hikes, they can lead to some amount of growth shock down the road. And that's why it was important for the central banks to take a step back and really see how the effect of these tight financial conditions are playing out. The catalyst for on both sides. So one catalyst could be leading these central banks to probably go for a rate cut, and one catalyst can lead the central banks to even go for a rate hike. So I'll share my thoughts on both. So the catalyst which can lead these central banks for a rate hike probably is one, a major inflationary shock. So, like we saw during last year when we had the starting of the Russia-Ukraine geopolitical conflict, and we saw food prices, fertilizer prices, as well as the commodity prices going up quite sharply in a very short span of time. Uh, if something were to happen on those lines, or a weather-related disruption, like we discussed, El Nino, if that gets very prolonged or has a very strong effect on food prices, probably that can change the reaction function of these central banks towards maybe a couple of more rate hikes if needed, especially on, I think globally, I would say rather than domestically, if those inflationary concerns were to materialize. Because like I said, we are much closer to our target compared to what's happening globally. So probably RBI is not really in a very, uh, you know, very strong, I would say, catch-up phase compared to what's happening globally. The other catalyst which could lead to rate cuts is one, a meaningful growth shock, like we saw during the month of March when we saw some of the regional US banks, going under bankruptcy and leading to concerns of very tight credit conditions. The second catalyst could be further normalization of the supply chains and further deflationary food shocks as well, which could lead to those inflationary expectations finally coming down, and probably make the central banks consider policy easing. And the third catalyst could also be some disruption in the US labor market. So far, despite all these rate hikes, the labor market in the US has been quite resilient. But now, as we have seen, even in the tech space, even in some manufacturing space, there has been some weakness, although wages continue to hold up. But like as we go along the year, probably a more pronounced labor market weakness could lead to a catalyst for a policy easing. Thank you.
Thanks, Anurag, for such a lucid answer to that question. So, pretty relevant. May I request you to stop sharing your screen? So, I'll take the questions. So, the next question to you is, although the current interest rate and inflation environment in India are favoring, what, according to you, could be potential hurdle for Indian market looking at the global economic slowdown? So, this is a question coming from Mr. Kunal Kapadia.
Sorry, how does the Indian market?
What according to you are the potential hurdle for Indian market looking at the global economic slowdown?
Right. So if you divide India's growth drivers into consumption, capex, government spending, and net export, which is your textbook equation of GDP, which is C plus I plus G plus X minus M. I would say the government spending continues to be quite strong, and as we saw even during last year, there is a very strong renewed thrust on capital spending, and that's leading to a huge fiscal boost to the GDP. If we look at the net exports, although the goods exports are slowing down, the service exports are making up for the loss in good export. But if the global economy continues to slow down, there was a big expectation when China reopened from its zero COVID strategy that probably at some point of time, Chinese growth will come back and lead to a strong demand for commodities, which has not really, panned out. In case, the growth, Chinese growth continues to be weak, or there's a further growth shock to the rest of the world, the weakness in the goods exports could be much higher, and maybe the service exports will not be able to compensate. So that's one risk that we see on the Indian economy, especially coming from the global side. The second is, even we have seen tightening of financial conditions. So the whole move from the reverse repo rate of 335 to this current move of 6.5, that's also led to significant repricing of fixed deposits, of government bonds, as well as loan rates for most of the consumers, and that could lead to some slowdown in consumption. And as we know, consumption is the biggest driver for the Indian economy, accounting for more than 60% of GDP. So any slowdown in consumption can have some knock-on impact on our growth as well. So that's something which we should watch out for. Thank you.
Sure, sure. So here is a next question to you. So we saw the 10-year GSEC in India peaking out at 7.6% same time during the last year, so somewhere in May, June. So now moderately trading at around 7%. So despite the increase in rates by RBI. So what is causing the rates to moderate, and where do you see the 10-year GSEC yields moving from here?
Right. So as we have seen in previous cycles also, the bond pricing or the bond market expectations work on forward pricing. So when we saw the whole move, when 10-year bond yields moved all the way from 6.5 to 760 last year, that was on the expectations of aggressive policy normalization from the RBI as well as global central banks. And hence we saw that 100 basis move. And if you look at the current moderation is also because of the forward pricing mechanism, because as the bond market is realizing that probably we are close to the terminal policy rates, and the next move from here on would be lower than higher. And hence, we are seeing this rally in bond yields across the globe.
All right. Yeah, thanks. So the next question is, this is on the recent development which has happened in MF, which is the SEBI has allowed MF to now participate in repos on commercial papers and certificate of deposits, right? So what is its immediate impact on the portfolio yields, and which set of funds are likely beneficiary of this particular development?
So it may not affect portfolio yields in a very meaningful way, especially in the near term. Because it also depends on the quantum of repo market which is available to the mutual fund space. It also depends on the arbitrage between the overnight rate, other alternate CPs, or doing repo in these instruments. Because mind you, a mutual fund scheme can also buy CPs directly than doing just a repo. Although in the long term, I think it will lead to more liquidity and better price discovery in many of these money market instruments, because many participants today which refrain from buying CPCDs because of liquidity concerns today can buy those instruments in future, can participate more actively, and they have the option, just like in GSEC market today, many participants have the option of, let's say, rather than selling government bonds, repoing them and getting that liquidity. If the same market were to develop in these money market instruments also, that can lead to better stability in this market instruments, because a counterparty can then borrow against this instrument rather than selling them in terms of liquidity stress.
Sure, sure. On the same lines, there is another question. So the banks actually remain wary of participating in the longer variable reverse repo rates, right? The RRR auction, I think that was which was announced 2 weeks back by RBI.
Right.
But somehow the banks actually remain wary amid the fears of scheduled tax outflows, and also reducing the surplus liquidity.
Right.
So how is this likely to impact the overnight rates, and also your outlook on the near-term?
Right. So that's a very good question, Niranjan. So what was really happening was RBI was introducing slightly longer term variable rate reverse repo auctions. And since there was an expectation, and the expectation was right, that there will be some outflow from the banking system because of advanced tax as well as GST related outflows, they didn't want to lock up their liquidity for a very long term, because that would have led to a liquidity mismatch situation at the time of those outflows. So RBI also modified the tenor of those reverse repo from 14-day to more shorter term repo, which led to better success and deployment from those banks. Nevertheless, what it means is that RBI is quite clear that the operative interbank rate needs to be near the policy rate. So if you remember before the conduct of those reverse repo auctions, the overnight rate was quite volatile. It was on some days it was going to 670, 680. On some days it was going to 620, 630, which was leading to huge volatility even on the short end of the yield curve. So now with these reverse repo auctions in place, and as well as market expectations now much better anchored, that RBI is quite serious about 6.5, it leads to a more stable pricing of the money market yield curve, and coupled with these measures of such as dividend payment, as well as this 2000 rupees exchange which is going on and leading to better liquidity, we expect money market rates to remain stable in the near term.
Sure. Thanks, Anurag. Like you said, the system liquidity continues to be in surplus mode, right? So while the policy rate and the other liquidity adjusted facility rates are unchanged. So how do you see the short-term yields moving on this backdrop?
So given the infusion of liquidity because of these measures, we believe that at least in the near term, short-term rates can remain anchored. So if you look at the shape of the yield curve today, a 3-month CD or a CP is trading somewhere close to 690 to 695. A 6-month is trading close to 710, 715, and a 1 year is trading around 730, 35. Given that the policy rate is expected to remain anchored, secondly, market participants, even if you look at the swap curve, are not really pricing in rate cuts near time soon. Hence, we expect largely these rates to remain stable and remain more a function of credit growth and deposit growth rather than a function of policy rates. So typically, since credit growth falls off in the second quarter of the fiscal year because it's a lean season and it usually picks up in the final quarter, we expect money market rates to remain moderate and remain easy because there is no pressure from banks to aggressively hike deposit rates to lend on it.
Sure. Thanks, Anurag. There are a couple of questions again on the credit funds and also on the long duration funds. So we will take them now. So one question on the long duration fund side. So the strong demand from the long only investors has led to the significant performance of longer end of the yield curve over the last 2 to 3 months, right? So however, the yields continues to be flat towards the longer end of the curve. So what should be the investors' approach at this point in time when it comes to investing in, say, constant maturity 10 years DSEC or a gilt fund or a long duration funds?
Right. So we believe that investment in constant maturity 10-year or gilt funds is largely an asset allocation call from investors who are comfortable with intermittent mark-to-market volatility. Investors should not try to time the market. If we look at structurally, India is moving towards its inflation targets, although gradually, but nevertheless, they are moving towards an inflation target. We have an independent central bank. Even if you look at from a fiscal perspective, government is on a consistent fiscal consolidation path since COVID. So from a long-term perspective, we believe that investors should make some allocation towards these funds, but from a very long-term mindset. So rather than looking at near-term factors, we believe that it should be a systematic allocation to these categories, just like they make towards equity. Just to add some counter cyclicality to their portfolio, they should be looking at these duration funds. From a long duration standpoint, because the minimum duration that these funds are expected to maintain is 7 years, and at a bare minimum, investors who are looking from a very long-term perspective, which is, let's say, 5 years and more, should look at these long duration funds. And they should not try to look at it from a tactical standpoint. And hence, we don't think, from whether the current market rally or the next 3-6 months, what RBI policy will do really should influence them in any way. It's a long-term asset allocation call. So whatever they're allocating to fixed income, and so whatever money they can allocate from a 5-year standpoint, some part of their allocation can move towards a long duration category, but they should not look towards very near-term factors. On the very near term, why long has performed, it's largely performed with one, as we know, there was a change in taxation rule for insurance companies, and hence we saw significant flows towards these category in the last week of March, which led to very strong demand from these investors in the period of April to June, and hence we saw the flatness in the long bond yield curve, which we don't expect to sustain in the near term as the supply starts to come back and the demand starts to fade out.
Sure. Thanks, Anurag. So, in fact, there is a question on taxation. So, before we move there, one question on the credit fund. So, how is the credit cycle looking now? So, can investors look into adding credit to their portfolio at this point in time?
So, if we look at how the economy has done and how corporates have behaved, so if you look at from 2020, corporates largely, and especially corporates who were more exposed to capital markets, they have been on a deleveraging path. So if you look at the balance sheet of many of these corporates, whether on the commodity space, real estate space, or any other sectors, many of them have taken advantage of strong revenue and profitability growth of the last 3 years to deleverage their balance sheets. So the starting point for, let's say, a credit fund investor is looking good. But again, credit should, given that credit is susceptible to, adverse shocks during a business cycle. So even if we pick out the best private sector bank in the world, even those banks have report some NPAs during the part of the business cycle. So as long as the investor is comfortable with some adverse credit movement, an investor can consider some allocation to credit strategies. But one, it should be a limited part of their fixed income allocation. Secondly, they should be comfortable with some adverse credit movement during a course of the business cycle.
Fair enough. Thanks, Anurag. So, this is a question on the taxation. So, in view of the change in taxation for debt schemes, so how should investors look at this space going forward? So, this is a question coming from a couple of viewers online: Balu, Rama, Murthy, Abhijit, Patil, etc. Yeah.
Thanks a lot. So it's a very valid question. So there are, alternates which are emerging compared to fixed income mutual funds that probably investors can consider. Of course, the fixed deposit or other, strategies. So when we invest in fixed income, and I think we need to take a step back and really see that why we invest in fixed income in the first place. We invest in fixed income in the first place for one, preservation of our capital. That is, we want our capital to be protected. Secondly, we want regular income, probably. The third is we want liquidity. And now if we look at mutual funds compared to their alternates, I don't think anything has changed despite this, the changes in the taxation. If we look at mutual funds, because we have a very diversified portfolio across set of issuers and set of sectors, that is, we cannot take any concentrated bets. From a stability of capital perspective, mutual funds still provide a lot of value. The second reason, if you look at now, thanks to SEBI categorization, an investor knows that the kind of duration risk or the credit risk fund could be undertaking, and they can match their duration preferences to the duration preferences or the duration category of the mutual fund. For example, if an investor is looking at a 6 to 12 months investment horizon, rather than getting confused across the categories, an investor knows that, okay, I can invest, let's say, in a money market fund or a low duration fund which carries a moderate amount of duration risk. So they can match their investment horizons with the category of the mutual fund scheme. The third is liquidity. So whenever we try to exit from our investments, especially in a mutual fixed income allocation, that should lead to minimal impact cost uh, from an investment point of view. There should not be ideally any premature penalty. Ideally, there should not be impact cost if I'm trying to sell it on the exchange or any major other cost. And if you look at mutual fund schemes without an exit load, you can redeem your money in a very short span of time without any exit or a transaction cost. Since mutual funds trade in interbank market, even if we are selling bonds in interbank uh, space, it's much more efficient compared to transacting directly. So whether in terms of transaction cost, in terms of liquidity, in terms of diversification, in terms of your the matching of your risk to the right category, we believe mutual funds still offer great value within the fixed income space. And hence, I think when investors look at the basic reason of investing in fixed income, they will still find that mutual funds still offer great value to them.
Thanks a lot. I think very important points. Thanks for your inputs. I think in the interest of time, we will take one last question, Anurag, and this is the question to you. So what, according to you, could be the optimal credit and duration mix of portfolios an investor should have in the current scenario? And also, which set of funds do you recommend for an investor who is trying to build his core debt portfolio using an SIP, systematic investment plan?
Right. So like I said, so in answer to the previous question, when we are investing in fixed income, we are looking at stability of capital, we are looking at liquidity of our capital, and we are looking also for regular income. And hence, I think our allocation should also mirror these characteristics. So hence, so let's say for 100 rupees allocation to fixed income, some portion depending on the investors' individual needs. Maybe 5 to 10% of that should be invested in liquid and overnight funds, so that investor can enjoy easy liquidity with minimal impact cost at any points of time. And about 60 to 80% of their allocation, which is the bulk of or core of their portfolio, should be invested in high quality, moderate duration products, which is like your short-term income or your corporate bond or your target maturity index funds, which have a defined maturity as well as a moderate credit risk in those portfolios, so that the investors can enjoy stable income as well as easy liquidity on those portfolios. And for investors who are comfortable with either mark-to-market volatility, or they are comfortable with some adverse credit movement, but they want to generate some alpha, they can consider high duration categories such as gilt funds, dynamic bond funds, or they can consider a mix of credit oriented strategies. But mind you, it should be a very limited part of their allocation, and they should be comfortable with adverse mark-to-market movements intermittently. Although over a period of time, these categories can add some value, but in the short to near term, they do contain higher volatility.
Sure. Thanks, Anurag. So just a request to the participants here today. So please use the feedback link available on the screen to share the feedback on the topics that we covered today and on the webinar in general. So it will help us to do better in our upcoming engagements with you. And also, we hope that we have taken most of your questions today. So if you think there is any question which is missed out, so please do write back to us at askuti@uti.co.in or you can actually get in touch with our relationship managers. So we will be more than happy to get back on your queries. So with that, I will hand it over back to Anurag for closing remarks. Thanks.
Thanks, Niranjan, and thanks a lot for your very insightful questions. And hope you found this webinar useful. And good day to you. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.